Perfect. Welcome once again to Barcelona. We're going to start with what's next after the FTX crash. And Michael, I would like to start with you. You can present yourself. And then we move to Robert. And yeah, please just introduce yourself.
Yeah, sure. So presenting myself, I'm Michael Jackson. I'm a director of Fabric Ventures. We're one of the old guys in the venture scene in crypto. Myself, I met Jorn from Monerium earlier today. 10 years ago, we were on stage in a conference in London, probably one of the first on Bitcoin. So this is there are about as many people there as well. So that's kind of interesting how things develop. My own background is I've had 10 years in venture, and before that I was running Skype, which is a big distributed network, essentially based on the same technology of a lot of the crypto world. So that's what really was my natural lead into this space. Thanks.
Thanks.
Yeah, James Ryan. I'm the head of marketing at GammaX, which is a soon-to-launch decentralized exchange. I've been in the crypto space it's about 2017. I was the head of marketing at Brave shortly after it launched, and I've worked on a couple of other crypto projects in between, and now at GammaX since June. And prior to that, I was a journalist in the technology space.
Hey everybody, Kevin Murcko, founder and CEO at Coinmetro. We're a centralized exchange based out of Estonia. My background is in FX, so I worked in FX for 20 some odd years, did everything from losing money to prop trading to trading on a desk to figuring out how to trade, make some money. I went through the whole gamut and got into crypto personally around 2009 and then professionally 2017.
Hi everyone, my name is Robert Lay. I'm a crypto research analyst at Pitchbook. I do research. Most of my time I spent at Pitchbook doing fintech research, and recently we launched a crypto research team dedicated to this space.
Perfect. Thanks a lot. Michael, you get the first question. The narrative says that the FTX collapse could have been prevented with more regulations. What's your take about that?
No.
No.
This wasn't a regulatory collapse. This was a total collapse of company management, internal governance, whatever, excesses. We've all read the excess story. You just don't do that in large, real companies. It's quite simple. And even if you have regulation, you're going to have bad actors. They can be offshore, just as FTX was. It really wouldn't have made any difference at all. So the cry for regulation is real. It's open. And fortunately in Europe, you shouldn't read too much about what's coming across in the US. We're maybe going to speak about that later. But Europe's got a pretty good structure coming along the way. And we can talk a little bit about that. But no, FTX would not have been prevented by regulation.
Is there anybody who thinks something different on?
Yeah, I guess I would say it would have. I think the thing is SBF was able to sell FTX to its investors and to its customers that it was a legitimate exchange, but it had to offshore because the rules and regulations haven't caught up yet. And so I think that was one of the key components. So if the rules and regulations allowed for FTX to operate, whether in the US or in any other jurisdiction, SBF would have to operate in that jurisdiction. But because there weren't rules and regulations, he was able to hide behind that.
Yeah, I'd probably echo Michael a little bit here just to say that, I mean, in the FX realm, the Bahamas is actually one of the most stringent offshore regulators when it comes to foreign exchange. In fact, it's probably on par with most of MiFID, MiFID II, et cetera. It's not the same, but it's very similar. The problem with regulation is it's not 24/7. I mean, there's oversight, but oversight is not 24/7, 365. And if there's people that work for regulators that get paid really shitty salaries to look and try to find problems. And then there's really smart people that get paid really big salaries at companies that will absolutely create problems. And so, the system, just like the judicial system, is kind of out of whack because obviously if you can hire a $10 million lawyer and you can outbid the state, well, you can win your case. It's kind of the same thing. At the end of the day, no matter what companies do or what the regulator does, there's always going to be somebody a step ahead of the regulator. And so we've seen massive fraud. We saw MF Global, John Corazine back in the day with futures. We've seen everybody knows Bernie Madoff.
Bernie Madoff, yeah.
Yeah, and to be honest, those weren't stopped by regulation. And the thing is that, well, this wouldn't have been stopped either. Would it have been lessened? Maybe. Would there have been 175 companies with, I don't know how many billions worth of, bankruptcy? Maybe it would have been less, but it wouldn't have been stopped. Impossible, to be honest. I mean, fraud exists because humans are corrupt, and we're going to be corrupt whether there's regulation or not.
Yeah, I agree. There have been bad actors in traditional finance, traditional venture capital. We got the Thanos, situation. Regulation wouldn't have solved that. If you got people that are trying to defraud their customers and their investors, and the regulators can never quite keep up with as you said, the lawyers and the intelligent fraudsters out there. So people have to be wary. They'll continue to need to be wary in the crypto space. But yeah, overregulation certainly isn't the answer.
We all know that regulation moves slower than innovation. Everybody knows that saying, right? And at the same time, if you've ever run a business, you know that criminals outpace whatever you do to stop them. If you have a business that sells shoes online, there's people using fake credit cards all the time. Every time you do something to stop them, they do something else. At the end of the day, you can try, you can lessen, but you're not going to stop it. It's just human nature, unfortunately.
Thanks. A couple of you guys mentioned offshoring. What do you think is the impact of companies offshoring?
I mean, I'm not exactly sure what the impact is. It's sort of inevitable at this point. If the U.S. is going to have, the firmest regulatory framework or structure, people are going to seek less regulation. Regulation in and of itself isn't bad, but I think customers are, and rightly or wrongly, customers want less friction, particularly say with exchanges, and so the companies creating the exchanges are going to move to where they can set up an exchange with less friction, and that's typically going to be offshore at this point. I think as more regulation, or as less regulation appears overseas, and the U.S. maybe starts seeing that it's missing out on the market, they may pull back on that to be competitive.
Yeah. At the end of the day, running an exchange, running any type of regulated business, I want to be regulated, but I also want to have a business. And the problem is that obviously you have, everybody kind of shits on the regulator, which, it's easy to do. I do it too. We all talk bad about the regulator. But in reality, you got the legislator first, right? I mean, the legislator makes the legislation, which they don't read usually, and then they vote on it, it becomes law, and then the regulator is supposed to take that law, interpret it, and apply it to business. And the problem is because there's that separation, which there has to be because of conflict of interest, et cetera, but that creates a system where the person applying the law and interpreting the law wasn't involved, obviously, in creating the law. And so then you have market players like us who try to make our own interpretation to try and actually, we need to make money, right? And so if there's another jurisdiction where we can make money, and for me, it is important that we do the right thing, that the customers make money. We're not trying to go against the customer, don't trade against clients. All that stuff is important. But most kind of provisions that are put into law, whether it's in the US, whether it's in the EU, to try and stop, let's say, companies from doing bad against their clients, actually, many times, actually create more risk for the end user. And so if I have to go offshore to protect my client, I'm going to go offshore. I mean, it's just as simple as that. And the U.S. kind of the way the U.S. does this is usually, they create a legislation, they wait for judicial precedent, so some judge is going to come out and make some type, say this was wrong or this was done incorrectly, and then they apply it that way. And the problem with that is, we've seen with the SEC recently, right? I mean, it's kind of like, come in, tell us what you're doing, and then we'll say, yeah, we don't regulate that right now, and then go do it, and then we'll sue you 3 years later. And then Twitter's going to hate us. I mean, that's essentially the life cycle of, and that doesn't work. It's never worked. It hasn't worked to stop fraud. It hasn't worked to create a better environment for clients. It hasn't worked to create a better environment for business. But, I guess if it's broken, don't fix it. I guess that's kind of how the regulatory cycle works, to be honest.
I might put a little sort of VC or financing angle on this. As venture capital in this space becomes more normal, if you like, and the people investing in the funds become to be the pension funds and these kind of people that we've relied on to stimulate innovation for years now, these guys won't permit us to invest in companies that are in shady jurisdictions, you can call it that. They want us to be, there are state actors, for example, the European funds, the European government funds who give us money won't allow us to use European taxpayers' money in some weird Pacific island or something like that. And that's going to be forcing the better companies, the more reputable companies, the people developing really for the future rather than for arbitrage, probably to be becoming onshore just because of that, not because of regulation.
It's a good point. Actually, when we speak about kind of risk when it comes to a regulated enterprise, there's regulatory risk. So we're regulated in the EU, we have regulation in the US, Canada, et cetera, lots of different countries. And there's always regulatory risk, but the bigger risk to the company is actually not the regulator. It's the banks, it's all your counterparties, et cetera, that have probably more stringent rules that are applied to them than we have applied to us. And so in reality, you get regulated so you can make sure you can continue to operate. But then when you get regulated, you get kind of closed inside this really small fence, and you're forced to operate in a certain way that doesn't make, that leaves you less competitive than your non-regulated counterparties, right? So, you know, everybody knows the biggest exchange in the world that's not regulated. I'm not gonna say the name, you all know who it is, right? So to compete with a company like that can pretty much do whatever they want, right? There's no oversight on that business from any regulator across the world. And then you're boxed into this little box, and you have to compete. And the problem with that is that while the regulator may think that reduces risk, you know, around the entire, let's say, crypto sphere, it doesn't, because you're leaving the biggest company in the world, and you're allowing them to do whatever they want. But all these smaller entities have to follow rules, and that becomes an issue, absolutely. But it's a good point, because whether you want to be regulated or not, at some point you can't operate. You can't have, you know, you can't have fiat on and off ramps. You're not going to be able to cooperate with banks. You're not going to be able to cooperate with or get funding from, you know, sovereign wealth, or, you know, you have no choice. But it boxes you in, you know, and that's an issue. And that's an issue for just innovation in general, or expansion of the business, or et cetera.
Yeah, unfortunately, we're seeing this happen in the U.S. right now, right? We saw at the beginning of the year when the Fed, FDIC, and OCC came out with a joint statement telling banks that it's very risky to work with crypto startups. And then you see all the enforcement action that's happened over the last month. We see that in the U.S., a lot of the federal regulators are taking steps to cut off crypto from the banking system. And then what happens is it's going to continue to push crypto companies offshore.
And you see pressure on the banks as well. Everybody sees the news about Silvergate, right?
Yep.
Where they're now being sued, and they're being intertwined in something that they probably had no direct influence on. They were simply a counterparty. But because they're more highly regulated, you know, nobody's going to sue the unregulated counterparty, because where are you going to sue them? Where are you going? What jurisdiction, et cetera? How are you going to win? Who do you actually complain to? So they go after the regulated entities. Yeah, it's a vicious circle, really.
Do you guys think that we touched the bottom? Or where do we stand?
Yeah, I think this most recent bottom was not the bottom, right? We hit lower bottoms, you know, say back in 2010. Right, so this is just another bottom, but it's really nowhere. We can't refer to it as a rock bottom, right? And I think it was the most recent crisis, you know, combined with the crypto winter, I think has been a real test of the system. And a lot of people were expecting or predicting a complete collapse and complete loss of faith. But I think what it's shown people is, okay, we've weathered a number of like very serious crises, just like the mortgage industry did, or the you know the industries that Madoff was involved in, and we weathered these crises, and there's still faith in the system that, you know, we're here today to talk about it. So we did hit another bottom that I think we're moving up from, but I think it was never the rock bottom, right? So which again is a real indication of faith in the system.
How do you think we can rebuild that trust? How do you think we can rebuild that trust?
I mean, I think, you know, some of the stuff we've talked about, like, you know, a fair amount of regulation, I think, is particularly if we want to bring in more traditional investments, the insurance companies, the pension funds, they're going to be looking for, you know, some adults in the room. So I think, and we're starting to see that, and I think it's a necessary part of growth and development. So I think that'll be a big piece of it.
Yeah, I think there's going to be more disclosures that are going to be coming from any of these crypto companies. Financial disclosures, risk disclosures. I mean, even you look at, you know, Celsius and BlockFi, if you looked at their websites when they were advertising their products, they look like banking products. High yield, you get a debit card, like you couldn't tell if it was a bank or not. And like that kind of stuff, the false misleading stuff, and not knowing where your money is going, not disclosing that risk, this is something that will need to come to this industry for consumers to come back and start trusting crypto companies.
And anybody ever read like the terms of service when you sign up for a new Apple product? You ever read that 47 pages when you download an app? I haven't. And you know, I think disclaimers work to a certain extent because it's a legal backdoor. You're like, well, we told you might get wrecked, right? So you got wrecked, so sorry, but you signed the agreement. I think at the end of the day, trust is a weird thing in crypto, because at the end of the day, if you read the Bitcoin white paper, it was supposed to instill trust based on removing the human element from the equation. That was how trust was going to be built. And if you look how traditional finance has always built trust, it's the human element, literally. The counterparty system was created so that you had a third party to basically bring trust into whatever transaction you were doing. Probably everybody in the room could probably say that doesn't work, because it doesn't. Because if you have a counterparty or 3 counterparties or 5 counterparties and one of them happens to be corrupt or breaks the chain, well, then at the end of the day you have an issue. And so the whole premise here was that we were supposed to have this great technology that at the end of the day was going to remove the human element, and that's going to bring in trust. And then we created centralized exchanges. You're welcome. And that obviously brings in counterparty risk, just like traditional finance brings in counterparty risk. But no matter how much we want to say that normal people are going to use decentralized services, I got to tell you, user experience on decentralized services, for the most part, fucking sucks, right? And that's why the centralized counterparties are always going to exist. Now, how do you bring back in trust when one of those major counterparties just explodes, right? How do you do that? How did we do it when Madoff collapsed? How did we do it when John Corazine stole $10 billion and didn't go to jail? It's about creating an ecosystem. Regulation is part of it. Regulation is kind of just a stamp of approval. It's kind of like your buddy saying, buy Dogecoin, it's cool. That's what regulation does. And you're like, well, my buddy says it's cool, so it should be all right. But after that, you need people that are going to act a certain way. There needs to be like self-regulation. If you think about the best regulation in the world, I would come back to say that it's always been some form of self-regulation. And the problem is in crypto, we don't do self-regulation. The only time you see a self-regulating body is when a company needs to get a license. Coinbase went and created an institution in the UK when they wanted a UK license. They had like 4 members. They never did anything because they just put their name out there so it looked good on their application and it was done. But we haven't seen any real self-regulating bodies in crypto. We need self-regulating bodies. We need smart people in the industry. We don't need outsiders to tell us how to operate a business that have never operated the business. And I think that's probably the next generation of trust. On top of that, hybrid. At the end of the day, again, decentralized services will not be used by the mass populace. We can debate that for hours, but I 99.9% sure you will not see the mass populace at any point, 10, 15 years down the line, using completely decentralized services. There's a regulation element to that. There's a usability element to that. There's a speed and latency element to that. You're never going to have a decentralized service that's faster than a centralized service. It's impossible. It literally is impossible. So there's many elements to that puzzle that you're always going to have some type of centralized service. So those services need to go hybrid. What does that mean? You take the best of decentralized services, like decentralized settlement, so I can settle with you or you or you. I don't need a counterparty. I don't need to deposit with Coinmetro or with Coinbase or with Binance. And I can trade on a centralized order book, which is faster, more transparent, et cetera. That's probably where we're going. And I think that's where we kind of start to instill trust, because it's telling you, look, use our services. We don't want your money. And if you look at the collapse of FTX, what's the biggest flaw? Well, people gave them the money and they, gambled it away. And so that's, I think that's the next kind of step, the paradigm that we'll see over the next 1 to 2 years.
You talk about trust. I mean, most businesses we deal with, whether it's a coffee shop or whatever around the place, you trust in them, not because particularly there's a regulator totally all over them, but because there's a set of rules that have been placed by law and by custom about how you run businesses, just how you do things from day to day, and your business processes and controls and management team and things like that. You evaluate them an awful lot when these businesses are going on, and if you don't comply with the base rules of society, which a lot of them are really simple, you get fined or you go to prison and you'll get your business closed and stuff like that. If I send my business accounts in late, I'll get a demand from the let's call it the system. They'll want it within a month. If I don't do it within a month, they'll take away my business license, and that's it. And this kind of stuff is going to come into this space. It has to come into this space. It's basically there for anybody running like the real companies. It's just all these wacky things that sprung up that's broken on it. And to your point, I think it's extremely relevant what you say about DeFi. We're all really, really into all of this stuff. 4.4 million users in DeFi, right? I mean, it's a number, but it's not many on the global scale. So how do we get trust back? We get out of the media with some of this big high-profile cases that the media is interested in. Okay, 4.4 million people are a bit upset about some stuff. 1.7 million people in Celsius. I mean, it's not a massive number. It's not an unrecoverable number. You know, when we've got 4 trillion people on the planet, 4 trillion people, that's big, isn't it? 4 billion people on the planet. So, I mean, you know, we've got a huge market out there looking at exchanges are one thing, but other uses of decentralized technology for identity, for gaming, for all sorts of other stuff that we haven't even thought about yet, that's going to come along and be using this technology that we're building for. So, you know, so that's how we get some of the trust back, I think.
Thanks. Do you think, is it part of economic bubble, and can we make any historical comparison?
Yeah,
I mean,
is it part of a, I don't know, is it part of a bubble? Obviously this bubble was fueled by a massive injection of free cash that a lot of people got. Many of us got like Corona bonuses and weren't spending as much money, so we had a little bit of cash to play with. I think that was part of it. They talk about the US and other countries that gave people, like, really gave them free money that they didn't basically need. And part of it was to stimulate the economy. Well, this did stimulate the economy. A lot of it stimulated the crypto economy, which for better or worse is what happened with it. So that's a bubble caused by that. And then of course you've got the traditional FOMO bubble that we know so much about. And you know, maybe other people can talk to some of the other financial bubbles that have happened over time, right? This isn't new.
Yeah, this. I mean, the thing with crypto is the cycles are very short, right? I mean, the last bear market was not that long ago in 2018, 2019, and now we're in the second one. The thing is, our rules and regulations are going to come fast enough. We saw in 2018, 2019, crypto winter, about $800 billion of market cap was wiped out. This crypto winter, over $2 trillion. So what we know is if crypto does go back up, there's very likely somewhere down the line it's going to go back down again. And more people will get hurt. More people will lose money. And that's just the nature of any financial market, and the crypto market isn't any different from that. So, I mean, will rules and regulations come after this bubble, or will it be the next one? We don't know. I mean, they are coming slowly, but you know, you look at 1929 stock market crash. 4 years later, you have the 1933 Securities Act and Bank Act. And those securities laws are still applicable today, and it's created one of the largest capital markets in the world in the US because of those securities laws and investor protections. And so we expect that to come to the crypto markets as well at some point. We just don't know is it after this crypto winter or the next one.
Yeah, I think the big question in my mind is if those laws in 1933 didn't happen, or they were formulated differently, would we have a larger market or a smaller one? Or would we have a more wild, wild west market, or would we have a more structured market? Markets tend to clean themselves. You know, if you look at what happened recently with FTX, or Luna, or Celsius, or any of these collapses that we've seen recently, and you compare those to something like Lehman Brothers, I think Lehman Brothers was 43 billion was the number, right? We're looking at FTX, which apparently somewhere between 50 and 175 billion. I don't know what the number is, but no one knows the number is yet, but it's a big number, and it's bigger than Lehman. And if you look at pricing of the stock market after Lehman and how long it took to correct, and the amount of time that it went through Congress, and the amount of time that they talked about bailouts and how they were going to restructure the market, and what it did every time a senator came out and said, you know, oh, the talks aren't going very well, you know, because the Democrats, or the talks aren't going well because the Republicans, blah, blah, blah. All that did was provide more and more fodder for the market basically to go to shit. And in crypto, no one's bailing us out. No one's coming in with a check. Taxpayers aren't going to come in and foot the bill. Nobody's going to come in and give you your money back from FTX. You took a risk and you lost. And the market, price-wise, is right back where it was when FTX collapsed. It took 2 months. And if you think about kind of market structure, one of the big arguments from everybody is that, you know, this is a wild, wild west market. This market is, you know, immature, et cetera. And it is very immature from many different angles. But in terms of a market, I'd argue that it's slightly more mature than some of our largest markets in the world. Because at the end of the day, it doesn't need, you know, its mom and dad to come out and cut a check to get it back where it was. People simply take the loss and they move on. That's kind of beautiful, to be quite honest. In terms of bubbles, well, I mean, when you think about financial bubbles, they usually come every 20 to 30 to 40 years. It's about 20 years, roughly. It's like a major hurricane, right? Major hurricane hits like the east coast of the US or Mexico, Caribbean every 20 years. Well, there's a financial crisis pretty much every 20 years, almost like clockwork, right? Sometimes it's a little less. You can see them every 10 years, like we have in the last maybe 10 or 20 years. But in crypto, we see bubbles every year. Whether it's an innovation bubble, like, ICO, NFT, whatever, there's always some new thing that comes out that generally kind of creates a bubble, but that bubble never really pops. It just deflates a bit and stays there and waits for like the next innovation to come along to make it an actual bubble. And so every year we just create new bubbles, which is kind of interesting from an innovation standpoint, but it also begs the question, if we were highly regulated, would we have bubbles every year? Probably not. And so what happens when we do get highly regulated? Does this become boring? Is it going to be, us four talking to 3 people in 5 years because nobody gives a shit anymore because there's no more volatility? You can't make money on shit coins and Bitcoin moves like $4 a day and that's it? That might be where we're headed. That's traditional markets for you, right? Unless it's a, meme stock, nobody really cares. I mean, and that could be where we're headed. I don't know if that's good or bad, but, that might be the track we're on.
Yeah, and I'd like to expand a little bit on the point you made about the self-sufficiency of the industry relative to, say, traditional finance, and the fact that nobody was there to bail us out. In some respects, crypto at this point is already too big to fail. I think if it did collapse completely, it would cause huge ripple effect in the economy as a whole, in the financial sector as a whole, because so many companies do have investments in there, and when there was like a major failure, no one goes crying to the government to bail us out, in part because we're off operating our own. We're not depending upon the government for the regulation. The government doesn't see us as something that's, say, necessary to the economy that they're going to step in. And that's in and of itself a sign of maturity. Even though we're young, we're able to step up to the plate and solve our problems and not need mom and dad to come back to bail us out. That's a really good point.
The only thing I'll add is we just don't know yet because it's still early. I mean, the next bubble we might go to the government and ask for a bailout. They're just saying every industry gets one bailout. Except the auto industry, they got 2. But we don't know. Maybe in 5 years the crypto industry got real big and there's another crash that might happen. We just don't know.
I think those Trump checks were the bailout, to be honest. That was the first crypto bailout. That all went into crypto, right? Everybody bought Bitcoin with that $700 or whatever it was.
Sure. Are there any questions? Please raise the hand. I've seen him first.
Thanks for the talk so far. Been very interesting. You kind of had the consensus that regulation wouldn't have prevented FTX, and that self-regulation is what the industry needs. That doesn't sound like the best policy to try and enforce, because you can't enforce it, right? That by merit of what it is. What do you think the solution is in the long run for either regulators or for third parties to build in a sort of additional outside level of trust so that people are incentivized to make the right decision and to be self-regulating?
Yeah, I mean, I'm actually going to take issue with you saying that self-regulation doesn't work. There are many other industries where there are plenty of examples of self-regulating bodies that where the industry itself governs the way things work, basically for the best of the industry. And that to be running a business in that sector, you basically have to be, you don't have to be, you have to be a member of one of those self-regulating institutions. It's in the energy business, it's in the telecoms business, where I come from, and so on, where this is all happening. So you're not going to have a business if you're not complying by the rules set out by the industry. And they're typically industries where stuff changes really, really often. Because legislation, as we heard, it's framework legislation. It always has to be, because it takes 7, 8 years to go through the system, so you can never catch up with technology. In crypto, we're beginning to see it. Switzerland has a self-regulating body. I mean, I don't know if we've got any real view as to whether that's a success or otherwise, but we haven't seen any massive collapses out of Switzerland, you might argue, for now. That could be for many reasons. But I think self-regulating body does have a purpose and does have a place, and historically in other industries does manage. So I think we can do a lot with that, and with grown-ups in the room, which we heard earlier, managing these things.
Yes, likely it would be a combination of both regulations and SROs. I mean, FINRA, Civic, those are SROs in traditional finance, and then, they have all these regulations, SEC and other governmental bodies looking at them. So I think in crypto, that's probably the best way to work it out. You're going to have an SRO, but you're also going to have, so SRO is self-regulatory organization, and you'll also have regulations on top of that.
Do you ever have like a neighborhood watch? You ever live in a place with like a neighborhood watch? You have that old lady that comes out and like complains about everybody parking in front of her house and shit, and nobody parks in front of her house? That's an SRO. I mean, literally, at the end of the day, the great thing about an SRO is you have all competing companies that sit in the same membership. And so if you look at what happened with FTX, who's the first person to report on FTX? It was Twitter, right? And it was Twitter because there was somebody that knew what was happening and came out and started to report it publicly. And if I was a part of a self-regulating organization and I saw what was happening at FTX, you damn right I would come and report it to that SRO. Because, well, one, it behooves me commercially, because obviously I'm going to report it because I'm not doing the same thing. And so actually, you know, SROs are quite powerful, to be honest. At the end of the day, if you think about how regulators work, they work in a very similar manner. The only difference is that they're not insiders. But in an SRO, it's all insiders. It's quite powerful. It can be corrupt as well, for sure. But at the end of the day, yeah, neighborhood watch, think about it. You have an old woman for sure in the building you live in or the street you live on that complains about everything. And when she complains about it, it stops happening, you know? If there's a dog shitting on her lawn, she complains about it, the dog didn't shit on her lawn. Works. Great system.
I mean, I think when we talk about these things, it is about regulations are going to be they're going to be framework regulations. They're going to give some broad brush concepts about how things are going to work. And what we're going to see in crypto, in decentralized technology over the next 5 or 10 years is a move from the financial world to gaming world to all sorts of stuff we don't even understand. When we had the internet, like 1990, whenever, 5 or something, it was an information highway. It wasn't a trading highway. They forgot identity on the internet. They forgot payment in the internet. That's kind of why we have this stuff running now. And we're going to have to develop much faster than that. The framework's going to have to guide that, and the more specific that legislation becomes, the more troublesome it becomes, because it's easier to find a way around it the more prescriptive it is. And legislators don't like that. It's like the 10 Commandments, basically. They were a pretty good way to conduct your life regardless of which religion you have, you know, and it's kind of worked well for a bit of time.
Let's get the last question.
Son? Okay. Yeah, I've been in the business for quite some time, since 2013. I love the business, but it drives me crazy. Why are there so many goddamn scammers and hackers that come around? There's probably some in this fucking conference. How do we get rid of them? And why are they drawn here? Like, why are they drawn to this business so much?
I don't know. I mean, my view is enforcement needs to be harder and more effective on these things. I mean, we read even about the high-profile scammers in crypto and the big cases that we see, and they're still on Twitter, they're still going on, they're still acting, they're still trading, they're still doing stuff, and there doesn't seem to be any way of getting hold of them in the international law thing, right? Now, maybe that's a function of international law, is that if you break the law in Spain, you can go to the Philippines or somewhere and live a happy life. And as long as that goes on, it's all right. But how do you get rid of scammers? I mean, the first rule of scamming is you hide your identity. You want to prove that I'm somebody else. That's most of what this is going on. Decentralized technology doesn't lend itself to, to identity, self-creation of identity and things like that. But systems are coming along now that are going to enable that. So you're going to have an identity which is approved by all of us here, or other people, or a body, or whatever, that you're going to look after yourself. We've heard about self-sovereign identity. If you've been from 2013, you've seen them as well. Self-sovereign identity coming along, which means every single DeFi contract, every single activity you do online will be in somehow verifiable back to your real-world identity, which will be held not in a central, huge, great Experian database ready to be hacked, but by the decentralized ledgers around the world. And that technology exists today, and it's being built, and it's been built quickly. And I think this is one of the ways of getting rid of scammers, is to make sure that, at least if you're interacting with somebody, you've got a good idea who they are. Everybody knew who Madoff was. Everybody knew who SBF was. Everybody knew who half of these guys were. But the lowlifes, they hide in the shadows. And the more we can keep the shadows illuminated, I think the better.
Yeah, every industry has scammers. Every industry has hackers. Every industry has their... And if there was a recent Chainalysis report that put a spotlight on the amount of kind of fraud and or kind of bad actors in terms of transaction volume. It's actually a very small percentage of transaction volume. you know, as a centralized exchange, we see the same thing any e-commerce platform sees. You know, we see people with stolen credit cards. We see people scamming people on other websites and trying to use this as a payment gateway. All that stuff happens. I don't think we ever get rid of it. And I don't think there's any real way to get rid of it because at the end of the day, like we've discussed here already, people are corruptible and humans generally suck. And so at the end of the day, there will always be people that try to game the system. No matter how good the system is, there's always going to be somebody smarter than the system, and they're going to game it. And that's just what's going to happen. I think the problem really is we're too small now. So no matter what the number is, if the mainstream media came out tomorrow and said that, I don't know, 200 million was, you know, fleeced from retail investors in crypto, CNN, BBC, you know, Al Jazeera, every news network would put that on, and people are like, oh, 200 million. It's a terrible industry. We should shut it down. You know, nobody compares numbers versus transaction volumes. Nobody cares about the actual stats. They just hear a number, and it sounds big. But if they actually told the number of the amount of people that lost money to a credit card scam, it's billions every year. It's massive. But we don't talk about it because obviously, you know, MasterCard has better lobbyists than we do right now. But at some point, we will get good lobbyists. And we won't hear about this anymore because the market will be big enough where it might be 200 million or 2 billion or whatever the number is, but it'll be small in comparison. I think it's just about bringing some norms and standards.
I mean, but the MasterCard story, I mean, MasterCard, if I scam you, then MasterCard will refund you to get the trust in the system going. And we're beginning to see some of these insurance policies coming up in DeFi, for example, where you've got these insurance funds and stuff like that. And I think they're likely to become more popular because I'd rather be interacting somehow with a place which has got an insurance fund than not.
Sorry, guys. I know we would keep going for quite a lot, but the time has come. Thanks a lot. Thanks to our panelists. Thanks to the audience. It has been very inspiring, and please enjoy the rest of the convention.
Thank you, everybody.
Thanks, everybody.